Hi everybody, welcome back to the channel. Today I thought we would talk about the SPDR S&P 500 Dividend ETF or SDY. If you're new to the channel, thank you for tuning in. My name is Drew and I have worked on Wall Street previously. I worked at Wells Fargo Advisors and Charles Schwab. I also have my degree in corporate finance and investments. So I love this kind of stuff and I just love making videos about cash flow opportunities, different ETFs, dividend stocks, cash secured puts, covered calls, all those different things, real estate. So if you like those topics, consider hitting that subscribe button because we have a lot of content that is geared towards that type of stuff and really anything that pays a dividend we're talking about on this channel. So if you like that, once again, consider hitting that subscribe button. This ETF over the long term, you'll see this actually came out in 2005. And you might be looking at the performance, and we're up 137% since 2005, and it doesn't look too good on paper, right? Because we're only up 137%. Well, the S&P 500, the NASDAQ, everything else is up much more than that, right? So you might be looking at that and saying to yourself, well, that's just no good. But this ETF is actually focused on Dividend Aristocrats. Now, Dividend Aristocrats are companies that have consistently increased their dividends for at least 20 years in a row. So if we look at the actual strategy on the the page, you can see here that this ETF seeks to provide investment results that before fees and expenses correspond generally to the total return performance of the S&P 500 High Yield Dividend Aristocrats Index. The index screens for companies that have consistently increased their dividends for at least 20 consecutive years, and then it weights those stocks by its yield. And we have a focus on 20 years of consecutively increasing or raising those dividends. And by doing that, it's hoping to basically result in an increasing income stream for the investor. And a good example is like Coca-Cola. So I think Warren Buffett, I forget exactly how much he invested into Coke initially, but I know that it was thrown around that basically Warren Buffett is now making much more just off the dividends than he was his initial investment. And the reason for that is due to the fact that those dividends have gone up over time. So they've gone up so much, in fact, that he's making significantly more just off his dividends than he is his initial investment. With that being said, you'll see the expense ratio here is 0.35. This is not the best in the world. It's not the worst. I think anything over 1% is definitely expensive. 0.75%, especially in today's ETF market. 0.35 is kind of there in the middle. I mean, you have Vanguard ETFs that are less than 10 basis points. You have other ETFs that might be over 0.5% or 50 basis points. So this one's kind of in the middle. It's not great. It's not. I wouldn't even call it really good. It's just kind of in the middle in terms of the expense ratio. So. Just keeping that in mind. I mean, this ETF right here, if we look at the actual holdings, we can scroll down to exactly what this is investing in. So we have Realty Income. That's going to be a very common name out there. Realty Income is a real estate investment trust that I've known about this company for years, but basically they have a history of increasing their dividends every single year, and they've been doing so for decades, right? Same with all the rest of these companies. We have Chevron, a lot of commonly known ones, T. Rowe Price, Kimberly-Clark, NextEra Energy. We have a lot of companies that are very well known. In fact, I downloaded their spreadsheet, and I can actually make sure I have it on here, download it again, and we will go ahead and take a look at all their holdings. And I think it's over 100 holdings they have. And if we actually look at this a little bit closer, you'll see that, I know it's kind of small, but we have Royal Gold, we have Jack and Henry Associates, we have Caterpillar, Waste Management, we have Emerson Electric, we have Abbott Laboratories, Target, McDonald's, all the big companies. We even have a U.S. dollar allocation, so it tells you exactly how much it's investing in the U.S. dollar. We have an S&P E-mini futures contract, so it tells you exactly what it's investing in, how many shares it holds, and whatnot of each of these companies. But yeah, we have over 100 holdings, and so this is a very well-diversified ETF. And of course, it will determine the actual net asset value. So that share price you see, it will determine, or it is determined based upon these companies right here. So you'll see the weightings, 2.60% is the largest weight. So if you're looking for a very well-diversified portfolio that is focused on companies that have consistently increased those dividends for 20 years or more, then you're looking at an ETF like SDY. Now, we can actually take a look at the previous dividend history to see how this is faring and see if this strategy is actually working. If we go back, let's say 10 years, for example, you'll see that this ETF was paying less in dividends on average. And each dividend is going to be different, as you can see. So it pays on a quarterly basis. We have dividends of 40 cents, 41 cents, 38 cents, 44 cents, etc. We then fast forward to today, right? And you'll see those dividends have gone up. Now we're paying 97 cents, quite a high dividend relative to what it was paying previously. 88 cents, 76 cents, etc. So you'll see that the strategy is in fact working because those dividends are going up over time, and therefore investors are benefiting, right? So the strategy is working in terms of, hey, we're investing in companies, a well-diversified portfolio that is, focused on companies that have raised those dividends for 20 plus years, and we're seeing those results in terms of increasing dividends. So that's what we want to see, right? So even though the share price has not been going up that much over the course of inception, we can look at the last 5 years. We're up 28%. Okay, still not great because the S&P 500, the NASDAQ, I think are on all-time highs right now. So they're blowing things out of the water, right? And then it gets into the question like, what's your risk tolerance? What are your investing goals? What are you actually seeking? And I think this is a very important consideration because not everybody's going to have the same risk tolerance and investing goals. Like I see comments of people saying, oh, I would never invest in an ETF like this. But ask yourself, like, what are you looking for? Because an investor could take this ETF, for example, even though it doesn't have the highest return profile in terms of its share price, and let's say they throw this into a Roth IRA, just using this as an example. And let's say they invest $5,000 or they max out their Roth IRA. Let's say they do $7,000 a year into a Roth, and they only invest in this ETF, and they come back in 20 years. And let's say these dividends have in fact increased more. So now instead of paying 70 to 90 cents, now it's paying $1.70 to $1.90 because those dividends have continually gone up. So now you have the snowball effect, right? Just like people talk about with paying off debt, same concept. The snowball effect of basically reinvesting dividends in a tax-advantaged or tax-deferred, tax-free account, basically. And by doing that, what you have is these dividends just are snowballing, right? So you're getting more and more income over the long term. And when you're ready to withdraw those dividends and start taking money out, you're going to have a much larger nest egg just due to the fact that you're able to compound those increasing dividends over time and then continually put more money in, reinvest. So that's obviously the power of compounding. And then you are most likely going to benefit from some share price appreciation. You're probably not going to get a huge amount, since inception. You'll see the 2008 financial crisis definitely had an impact on this ETF. If you take it from 2008, it's looking a little bit better, right? But it just depends on what time frame you're looking at too. So anyway, guys, let me know what you think of this ETF. I find this one interesting. I think it could be a good ETF for some investors depending on what you're looking for. But with that being said, hope you guys enjoyed the video. Let me know what you think in the comments down below, and I will see you guys in the next one. Take care.